Credit Suisse could be on the verge of a total collapse. After the failure of Silicon Valley Bank, Signature Bank, and Silvergate Bank last week, Credit Suisse is now under pressure with CDS insurance on the bank surging in value. Credit Suisse is a globally systemic important bank, and its failure would be far more serious than Silicon Valley Bank. Credit Suisse is 4 times larger than SVB at over $800 billion in total assets, and other major banks have exposure to it. Credit Suisse has faced major stress over the past year, but its most recent slide of 20% today to all-time lows came after the Saudi National Bank, its largest investor, said it would not provide more capital to the struggling bank. Its shares also slid last week after it delayed its annual report after a call from the SEC questioned certain revisions the bank made to its previous filings in 2019 and 2020. Credit Suisse is currently trying to raise $4 billion in capital and has asked the Swiss National Bank for a show of support. Here is what Credit Suisse CEO Ulrich Korner had to say Wednesday.
As you heard me saying yesterday, and I like to reiterate that because it's highly important, obviously, at the Morgan Stanley conference, we are a globally, systemically important bank. And what that means is we operate under the highest possible, standards when it comes to capital, to funding, to liquidity, to our results overall. So that is, in comparison to other situations which we heard of and deal with since a couple of days actually, is not comparable at all. So we are a strong bank, we are a global bank. Under Swiss regulation, we fulfill and overshoot basically all, regulatory requirements. Our capital, our liquidity basis is very, very strong. And by the way, you saw that also today in a statement of the chairman of the Saudi National Bank, actually, who is one of our main shareholders, as you know, who said, look, very strong bank, very strong financials under a strong regulatory regime. So I think this is first and foremost, to get out with respect to the current situation. And secondly, you were referring to the material weakness in our annual report. Also here, we published the annual report yesterday morning, as you know. The financial results are not affected in any way by this statement. I'll come back to that. So the financial results are unchanged for 2022 and the previous years. That's an important fact here. Secondly, the material weakness refers to, call it the financial reporting controls, which is, if you want to, like a testing and monitoring environment, which is obviously highly important, there's no question. And we are doing everything, as you would expect us to do, to remediate the weaknesses. But again, the most important fact here is it has not any impact on our financial results. So what is out there and what we put out on February 9 are the right and the accurate numbers. I think that is the most important thing here. Yeah. And you have also seen that our external auditor, PricewaterhouseCoopers, has given us an unqualified opinion on these results. These outflows go back to more than 85% to the months of October and November, as you heard me talking about. And that was obviously for all our people, by the way, who do a fantastic job together with our clients, who I couldn't thank more in that situation. I will explain in a moment why. We have started a pretty unprecedented, I would say, client outreach program. And we started that on October 27th. That was the day when we were able to communicate our new strategy, and we couldn't speak before. We started to speak at the same day. So in the meantime, we reached out to more than 10,000 wealth management clients globally in like one-on-one individual discussions, explained the strategy, explained what we are doing, explained exactly where we are. I think that has created very good momentum towards the end of last year already. And that momentum traveled with us into Q1. And we do everything possible to keep up that momentum during the course of the whole year. And I think that is what we are doing to regain as many of these assets as quickly as possible, basically. Now, look, what is right in what you are saying. We have somewhat heightened attrition, which, in a moment of change where we are in, is not so surprising. I think the flip side, and that is also very important to see, is we have no issue whatsoever to hire strong people from the market because, and this is why, this is because the strategy which we communicated, which is an execution for the next 3 years actually, resonates very much. It resonates 100% with our clients, and it resonates fully with all other stakeholder groups. So in terms of the executive board, as you say, every one of my colleagues more or less new since a year and a half. Basically, all experts in their fields, all know these kind of moments and situations, and we are executing together as a team very, very strongly. Look, as I said at the beginning, try to say at least this is a very different situation where, these banks where globally and systemically important banks are like us. So you can't compare that at all. I would not, and you have seen the reactions taken in the US, I think very forcefully and very successfully so far, I must say. I would not expect that this creates huge spillover in the financial system. At least is my personal opinion. And again, with us, in terms of facts, has nothing to do. Even our credit exposure to SVB, which you are mentioning, is absolutely not material. So it has nothing to do with our facts around Credit Suisse.